Hi, welcome to Control and Compound with Darren Mitchell. I'm your host, Darren Mitchell, and joining me today is wealth coach at Control and Compound Financial, Christina White. Christina, how are you?
Hi, Darren. I'm doing great. Thanks so much for having me today.
Thanks for being here. So, today we're going to talk about kids' policies. We get a lot of questions on policies on kids and should we do them? How do we set them up? So let's just talk big picture and then let's just go through some of those common questions we have. So, if we think of big picture for a kids' policy, what are we trying to accomplish? I look at this and say, what I'm trying to do is set my children up for success. And that's what every parent wants. They want their children to be successful. But this policy on a child is really setting up for success. So, yes, we're going to save money. Yes, we're going to grow some cash value, and we'll talk about that. But for me, an equal part of that is teaching my children when they're kids and teenagers about how the infinite banking policy works. So they have an understanding of money. They're not getting taught in schools. They're not getting, we were never taught by our parents either how money really works, how this infinite banking policy works, how you should be in control of your money, how you make money, how business owners make money, real estate investors make money. So for me, it's like the big picture is really setting my kids up for success. From a practical standpoint, what we're doing is we all need to save money. We all need to want to save money for our kids' future. And this is just the perfect savings vehicle to do that. So it's going to be a specially designed high cash value life insurance policy. We're going to put money in. Cash value is going to grow tax free. And then at some point, the child's going to be able to use it for first house, first car, first rental property, first business, or whatever other expense you can use it for. But really, it's teaching that philosophy as well as setting them on a path for success. Anything to add there, Christina?
No, I think you definitely nailed it, right? We want to set our kids up for success and we really want them to learn about these strategies. If we can get them set up younger, that's just going to create that snowball effect for the compounding we're all looking for.
Yeah. How many times have you heard meeting with prospects and clients? I wish I had heard about this 20 years ago. Where were you 10, 20 years ago? So again, if that most of our clients, share that belief of wish I heard about it earlier, and this is really letting your kids even before they're aware of how it works, setting them up so they're going to know about it. And once the policy's actually on them and they get to an age that you can have a conversation about them, it's a little more real. It's like, it's stuff in theory is great, but when you go, well, no, this is your policy and how it's going to help you, well, you should see a kid get interested then.
Yeah, for sure. So today I think we should, talk about some of the questions we get when we're meeting with our clients. I know you said a big one, like, why didn't I meet you 20 years ago? Well, we also have a lot of other questions that come with kids policies that I think it's important for us to chat about as well. What are some of the big ones that you're hearing, Darren?
Yeah, I mean, just some of the simple ones is how old does my child have to be before I can set up a policy?
So the answer to that one is 14 days old. So they only have to be 14 days old, and then we can set them up with a policy. You're probably not going to be doing the education bit just yet on that one, but you can set them up at 14 days.
So how does a 14-year-old do an application? So what's the process on that?
So a 14-day-old is not going to do an application. Under the age of 18 or 19 in some provinces, it has to be handled by their parent or legal guardian. So the parent or legal guardian is going to do the application, sign on behalf of the insured, which is the child. They're going to answer any medical questions that need to get answered. They're going to handle everything. So at that point, under that age, the child doesn't even really know that you're putting it in place for them, setting them up for success. They won't find out about that until later on.
And what about insurability? So again, parents are gonna answer the questions on behalf of the child, and we all want to believe our kids are going to be healthy for the rest of their lives, and they're going to live to be 120, and everything they're going to have perfect lives. But one of the things, and Christine and I went through this. There's a bunch of people in our office that had kids or have kids that in their between that 10 and 18 age develop some medical situation, not fortunately not life threatening, but you know Crohn's, colitis, diabetes, these type of things. that will affect their future insurability. So we're always talking about the cash value and these infinite banking policies, and they're huge. Um, but I'll tell you from personal experience, having a policy on a child, and then all of a sudden they develop a condition that may make it more difficult for them to buy life insurance. So we're not going to have a big death benefit on it. And again, I don't want to focus too much on the death benefit, but it's relevant. So when you have a policy on a child, the cash value grows, but so does the death benefit. So let's play worst case scenario and say, well, what if that child's not able to buy insurance when they get older and they want to start a family and have children of their own? Well, by that point, the death benefit would have grown, half a million, a million, $2 million. So it is significant death benefit to protect their family as well. So again, hopefully everyone's kids are insurable now and insurable for the rest of their lives. But the reality is, locking in that insurability is huge. So people say, what age should I start a policy? And the answer is like today. If your child's healthy today, start a policy today. Yes, we can do multiple policies, add policies down the road. They can buy them themselves when they get older. But starting that initial policy when your child is healthy is huge. Some of the other questions we get, Christina, can I buy can I buy this policy on my child, or can I buy it on my grandchild?
You can actually buy it on both. So you can buy policies on your children and you can also buy policies on your grandchildren. So you can, yeah, you can definitely set them up on both and set up that multi-generational wealth transfer we talk about. So the multi-generational wealth for families.
Yeah, we actually we just we did one not too long ago, and it was a retired business owner in his 70s, successful, and he had his first grandson. I think the grandson was two, and he wanted to set up a policy. So the way they're planning it, and again, this is key now because he's involved his daughter in this discussion, and his grandchild will be eventually involved in the discussion. But he's funding a policy on his grandchild, and that family strategy is for the next 10 years, the grandparent is going to fund that policy. After that, it's going to be assigned to the parent, and the mom is going to fund that, is the plan, for another 10 or 15 years. So now we're going to bring the child up to mid 20s, and then at that point, now that policy is going to be passed on to the child, and the child can use that policy. So, all kinds of different ways to structure it, but you can put it on your kids and your grandkids.
Yeah, so you talk about assigning the policy to the parent and then passing it down to the child. While we're doing this, there is a substantial amount of cash inside of these policies, especially when we're setting them up younger. So a huge question that we always have is, what does CRA think of this? What do they think about it when you're passing these policies down to the kids and to the grandkids?
Yeah, great question. So we're blessed in Canada that we have really clearly defined rules with respect to insurance. So for the kids policies, it's covered in Section 148 of the Income Tax Act, and it clearly states you can put money in a policy, it can grow tax free, you can borrow tax free, the death benefit is tax free, but also in Section 148 they specifically talk about kids policies. So if I start a policy on my child, cash value or money goes in, cash value grows, continues to grow. 10, 20, 30 years down the road, I assign that policy to my child. CRA Section 148 states that is a tax-free transfer. So not just the cash value and the death benefit, the ownership, but the growth as well. All of it is going to be tax-free. So we're blessed in Canada. It's a black and white issue, tax-free transfer to the child.
Which makes it a really great estate planning tool as well, right? You don't think of it that way because you're setting it up on your kid and they're the insured. It's going to be around much long after you, but we can use it as an estate transfer tool because we can pass down the wealth that you might have been giving to them anyways in this really tax efficient manner, right?
Yeah, and that leads me to another question we always get is, well, do I have to give it to my child? And well, the answer is no. I mean, when we set up this policy, you are the owner, you are the parent. The parent is the owner, payer, and beneficiary. The child just happens to be the life insured. Being the life insured gives you zero ownership or control over this policy. So, we all have great kids, and they're all going to continue to be great kids as they become adults and older. But let's say your child is going down a path that you're not excited about. There's no requirement for you to hand this policy over to your child. You can decide you want to use the money and borrow it and use it because you own the policy. You can decide to cash it out and take the cash. Now, we wouldn't recommend that, but that's an option. So you have complete control, and you decide when or if you're going to assign this policy to your child. Maybe at 21, your kid just isn't ready to take that on that responsibility. Maybe you wait till 25. Maybe even stop funding it for a while, but you leave it there and say, well, until they're going down a path I want them to go down, then I can assign it. So again, until you hand over that control to your child by assigning them as the owner, you have complete control over it till that point.
All right, so when we're setting these up, how do we set them up for a child? How is it different than when we set them up for a parent when we're doing the setup? That's another question that we get.
Yeah, so they work a little bit differently than a policy on an adult. Um, Ironically, we actually have lower cash value in the early years than we would on a parent. So sometimes it's like, well, this works so great on me. What if I put it on my child? Well, we can't really do a large policy on a child. And the first policy, 100% should be on the breadwinner or the key person, the key parent financially. So typically the breadwinner, because again, we're focused on the cash value. So if you're going to start one policy, start it on yourself, the breadwinner. Going to start a second policy, great, we have a spouse, and then we get into the kids policies. So kids policies, the cash value doesn't grow as fast, but it's designed that way because long term it's going to be absolutely phenomenal. But typically, if you start a policy on a 2-year-old, by the time they're 4, they're not looking to access a lot of cash. So we don't have as high a cash value as we do in a parent policy. Long term, we blow it all away because we have the power of time, right? We have compound interest uninterrupted for 100 years. So if we look at a specific policy, there tends to be, or there's always a minimum and a maximum premium on a whole life contract. So let's just use some numbers. Let's say it's $300 a month is the total premium you can put in. Well, that would break down to say $200 of base premium and $100 of overfunding. So if someone said, great, we want to put in $300, great, we can max fund it and put in $300 a month or 10 grand a year, or 20 grand a year, whatever. But if it's $300 a month, you can do that. Or another approach, if you're not going to really need the cash value, well, that overfunding, the deposit option between the 200 and 300, that's what grows your cash. But maybe you'll instead say, why don't we start a $300 a month minimum premium with the option to put in another 150 a month, but I'm not going to put in that extra 150 a month. So you're still funding it at 300. But I know in a couple years, great business is going well. I'm going to be more successful. Well, then in a couple years, you can bump it up to 450 or 500 or 600 because you can go back and make up those deposits you didn't make. So if there was room for 450 and you threw in 300, every month you're accumulating $150 of room that you can put in. So that can be in a lump sum, that can be in an increased contribution. So typically on the younger kid, where that's not going to be used in the next, short to midterm, they may or may not be overfunded, and we're trying to build in that extra room. And I mean, just one last thing on that. Speaking of room, like I always call it or lots of us call it planning for windfalls. So let's say we have a policy where, great, there's either an outstanding loan, your child's used it to buy a house, a property, business, whatever, or payments have stopped, or you're not overfunding it every year at some point. Well, what it does is it creates this opportunity to put in lump sums. So when your child starts making money, or when you have a bonus, or when maybe there's a death benefit on the parent's policy and the child inherits money, it's a great time to go back and say, now we can max fund that policy. Now we can pay off those loans because we have a built-in banking system to fund, or we were able to fund with those windfalls. So typically kids policy, they're going to be, probably the average would be $5,000 a year. Once you get over 10,000, insurance companies really going to want to look at how much coverage does the parent have. They're not going to allow us to put no coverage on the parent and then a $20 million policy on a 2-year-old. But anything reasonable from a few $100s up to 10,000, maybe 20,000. Again, unless the parent has significant cash value, then we can get into slightly larger policies.
Yeah, I like it. Windfall planning. That is important because these policies are going to be around for such a long time, right? The kids, these ones are the long-term policies. Now, we talked a lot about building up the cash inside of the policies and, putting in those deposits. What are people using these for? It's another big question, right? What are we using these for our kids?
Yeah, so what you're able to use it for, well, the possibilities are infinite. So just like infinite banking, there's an unlimited things you can do with it. So if you want to use it for buying a bicycle or paying for a trip, that's fine. You are totally in control, or the owner. So you, while you own it, your child while they own it. So there's no limitations like an RESP. You don't have to use it for university. You certainly can. It's a great vehicle to save for university, and we'll talk about that. Um, but what happens if your child doesn't go to university? So I have two kids. One decided after a year and a half, maybe university isn't my thing, and taking a pause now. So what could you do with an RESP? Well, you're really restricted because you start taking money out of an RESP. Now you've got tax implications if the child isn't in school, paying back grants and stuff. So it really complicates what you can use it for. If I could go back, I thought I was a hero dad when I did it when my son was 2 and my wife was pregnant with our daughter, funding this large amount into an RESP and getting it going. Well, now I look back and go, well, that money's been in jail for 20 years now, or 19 years. That money's literally been in jail. What could I have done with that money if it was inside an insurance policy? Maybe I could have bought an income property, use that money, paid back the loan by the time they start at university, and use it for university. Or if it's not university, maybe it's to help them start that business. And one of the things I'm looking at now is using the policy to help one of my kids buy their first property. And so it's really unlimited what you can use it for. Yeah, you can use it for expenses, but I like opportunities, and there's no limit on what you can use it for.
Yeah, and opportunities for kids, right? There are so many different things that we can be using them for. One thing to note when you're talking about, using it for a bicycle versus using it for school versus using it for real estate. One thing to remember is because you are the owner of the policy, you are making those decisions, right? Just because your child's the insured doesn't mean that they're deciding that they're going to buy a bicycle, because, my son would probably want to buy a couple dirt bikes with his if you let him have the ability, but we're not going to do that, right? We might end up using it for university, although he says he's going to get a football scholarship. And if that's the case, then, we can keep it. We're not going to use it for the university, hopefully, and we can use it for the down payment on the house or other things that come around that are going to work and, grow your kids' assets and their wealth and everything else as we're doing this.
Yeah, I mean, picture you have two kids, and one child goes the university route, and there's no problem with that. I would encourage him to take a degree that's actually going to get them a job and provide them a skill that make them employable. And then say the other child at 18 says, we have a couple clients that they went into a trade. Great, they went into carpentry, and now all of a sudden at 19 and 20 they are actually making really good money in a field they like. But that child didn't go to university. So are you only going to fund your child that went to university with an RSP? What are you going to do with the other child? So, it's great that because you're in control and can do whatever you want with the money, maybe you can say, all right, well, I'm going to help this child with $50,000 for university, and I'm going to help this child with $50,000 for starting their own business, getting their tools, buying their first property, whatever it is. So really that flexibility for me is huge, and being in control of the money is control and compound. We talk about those words all the time, but instead of putting your money in RESP, to put it in a vehicle that you control. So let's say the kid's 7 and all of a sudden you have an amazing deal that comes along and you need to access money. You can borrow from your kid's policy because you're the owner, you make all the decisions. And as long as you pay that loan back before they say go to university, well, great. That didn't affect the long-term growth of the plan because it's going to grow the exact same whether there's an outstanding loan. So it goes back to being in control of your money. Christina, any more questions we've got here? Does my child have to fund it when I assign it to them? So typically a kid's policy, you're going to have the option to pay for it for like up till age 90 or 100 or longer. But what if I assign this policy to my child when they're 25 and they're like, mom didn't know what she was doing when she set this up. Insurance is silly. And what happens if the child doesn't fund that policy or doesn't pay the premiums? Would it still continue on?
Yeah, so most of these policies, well, all of the policies when we're starting them younger, there's going to be cash value that's building up inside of the policy that can be used to fund it in the later years as well, right? So just because they're not making those deposits each year doesn't mean that our money's not continuing to grow inside the policy. We also have the ability to set them up so that they are 20 pays. So if you're concerned about that and you really want it paid up and done, you can set it up so that 20 years, not another deposit can go into it. Don't always recommend that because, when the kid gets older, they're probably going to want to use it. There's not any other bank account out there that's going to give them the returns that this one's going to give them. So we don't always set it up that way, but some people, they want that structure. But even with those ones long term, there's going to be enough cash in there that's going to keep these policies going for them, for life.
Yeah, what I like about it is because we're putting significant cash value or growing the cash value. Yeah, the kids can take a 5 or 10 year hiatus and maybe not fund it, and then all of a sudden they wake up at 30 and go, you know what? Mom wasn't that dumb after all. Maybe this is pretty good. And they can go back and they can make up all those deposit options they didn't put in. They can go back and make those up so they can put in a windfall. They can start saving. If you think of the compound interest curve, typically it starts slow and then eventually, it's going to be growing exponentially. So as a 25-year-old or as a 30-year-old, picture giving a banking system where, that first 10 or 20 years of the compound interest curve already has happened. So now you're into the really exciting part of the exponential growth curve. So if you're going to start saving as a 25 or 30-year-old and you have this policy, there's simply no other place that you can save that you're going to have the same benefits that you would from this. And that goes back to the teaching the kids how the policy works, why the strategy makes sense. So that education piece comes into play there. Now, my kids hopefully are, I don't want to say brainwashed, I want to say convinced that it's a great way to save money. But when they start seeing those cash values and going, wow, well, if I put in 5,000 this year, it's going to grow by 8 or 9,000 or whatever the numbers are. It's really impactful for them. So you're really, again, just setting that kid up for success. Anything else, Christina, before we wrap up here?
I think the education piece, like you said, is it's very important, right? You get them listening to these podcasts, you get them reading these books, you get them invested in learning about it, and they're never going to look at it and say mom was silly, right? Like they're going to look at it and know, shoot, well she must have been pretty smart because it seems I am one of the only 30-year-olds that can go out and get that real estate deal going and those types of things. So education piece is key for setting our kids up for success, and one of these policies provides them with the tools and the education to do it, right?
Absolutely. All right. Thanks, Christina. So to recap, kids policies, 100% makes sense. Grandkids policies, 100% makes sense. But it's going to come after we have a policy on the parents. Then we set up a policy for kids. And again, deal with someone that does these all the time, someone like Christina, and call our office if you need help or contact us. Please like and subscribe. Thanks for listening and watching. Thanks for tuning into this episode. Don't forget to like, subscribe, and hit that bell button so you always know when new content is coming out. For more helpful tips and tricks, visit our Instagram, Facebook, or TikTok pages at Control and Compound. If you want to reach out to us directly or work with us, visit our website at controlandcompound.com. The links are in the show notes below. See you next episode.